The subprime mortgage industry, that is the one that's charging 15% for these mortgages instead of 6% for these mortgages, that was City Financial, the subprime arm of Citibank, was charging an average of about 15.5% on its mortgages at a time when mortgage rates were a little over 6%. Where do most of those mortgages go? Do they go to help poorer families or less well-off families get into homes in the first instance? No. More than 80% of subprime mortgages are refinances. They're financing people out of their 6% mortgages and financing them into their 15.5%
Why are people
mortgages.
doing that?
Why do people do that? Why don't we ask City Financial? In the book, we talk about what happens when City Financial got sued for some of its mortgage practices. And one of its loan officers gave a deposition. Now remember, that's a sworn deposition. And he was asked exactly this question. How did you charge people so much at a time when interest rates were so low? His response, I'll have to paraphrase, but the exact words are in the book. Well, when we talked to somebody, because these were usually over the phone, and they sounded like they were old or young and unsophisticated or a minority, we just loaded on all the fees and charges that we had, and they usually would go ahead and pay. In other words, they counted on the fact that there's a lack of sophistication about mortgage products among many folks, and that they would not reveal true costs.
Can I summarize what I think
Yeah.
you're saying? You're saying that their argument is false because it has not created a stronger economy. They're taking advantage of people who don't know better.
Indeed, today's subprime mortgages, 1 in every 11 in the United States today is in default and foreclosure. They're not helping people get into homes, they're helping people get out of homes. This is the lose your home business, not the get your home business.
How about the credit card industry that's making money available to
Let's
people?
talk about the credit card industry. Last year alone, do you know how much people paid in interest and fees on credit cards? $90 billion in the United States. And who do you think paid it? I didn't pay it. It wasn't paid in the top 20%, and it wasn't paid by the bottom 20%. This is $90 billion that was drained out of the pockets of middle-income
but money alone
families.
doesn't, you know, I know this sounds odd, but money alone, amount alone doesn't say much. It's a question of percentage, isn't it?
Well, percentage of what? Families are now carrying 12% of their annual income in credit card and other short-term debt. Families are going broke under this load of debt. And let's look at the big picture. The credit card companies want to look at the big picture, then let's back it all the way up. What exactly is the long-term interest here? If families have spent next week's income and next month's income, and goodness, we're at the point now, next year's income, what exactly is going to happen to the economy? We only have two options here. Either there's going to be an extended period where consumers now have to underconsume to pay that debt back, right? You don't spend this year's salary, you have to spend 20% less than this year's salary to pay off that old debt. Or there's going to be massive default in the United States.
In other words, the day of reckoning will come.
The day of reckoning will come. The idea that we have a strong economy because we have pumped up consumer debt is just false.
It's another bubble.
It's worse than a bubble in this case. This is one for which we must either pay back or have massive default on the other end.
This excerpt is brought to you by the Massachusetts School of Law, the leader of reform in legal education and a leader in multimedia education for the public. To view the full interview and for a full listing of MSL's programs, log on to mslaw.edu.